Sheikh Khaled, I'd like to generally get your views. The result of this question has already been up. Is this a false thesis ultimately that this scale of disruption, this scale of the breakdown in the global trading rules system, right? There's rules, there's laws, international laws, there's WTO laws that took years and decades to put together on top of the GATT, which was there before, the GATT and then WTO. That's suddenly crumbling. Does that present a challenge or an opportunity or a bit of both for traders? And you're somebody who's literally in the process of setting up a trading company, KPC Trading, just opening its doors. So your thoughts on that as a thesis? And the survey results, not on the board, but if it could come up, we'll take it.
Well, thank you, Sean, for inviting me to the Energy Market Forum. And you always
Again, I'm going to do the repeated microphone.
You always choose the most difficult question with me, so I'll take this one. Well, in the trading world, we have to realize that, we have to comply with the rules and regulation. Either it's WTO or it's sanctions, whatever type of, let's say, rules that we have to frame. The traders is where they find the opportunity and how they can capture this opportunity within the legal frame that they can do it. Yes, there is challenges. Yes, there is many obstacles sometimes when it comes to this way. But I guess the rule and the job of the trading is to find the way just how to go around it. Trader's job is to find where is the arbitrage, where they can.
And does this present the opportunity for more arbitrage?
It's an opportunity, but sometimes it's limited to, sectors rather than other sectors. Because opportunities, let's say, if Europeans are sanctioning gas, then this one has to reroute and through different routes, maybe different direction. Ultimately, they have to find a way how they can supply other markets through the legal frame that they have to do it with.
Tom Baker, Vitol, Bahrain, recently taken up your position since we were here last, so congratulations to you, and obviously taking over responsibility for Vitol's operations in the Middle East and all of Africa. Your thoughts on the thesis, whether it's a bit of a false dawn or a false narrative or not? I mean, at the end of the day, all of you and your peers never made more money than 2 years ago when the Ukraine war happened, and one thought this is a very dysfunctional world, but ultimately in there lies opportunity. So your thought on the thesis of the question and whether it's more opportunity or challenge for traders?
Thank you, Sean, and thank you for the invitation here today. Well, definitely a mixture, I would say. I mean, you referenced 22 and 23. That was a combination of sanctions coming in, but we had guidance, we had warnings, there were wind-down periods. You also had a period of inefficiencies, lack of products going into certain regions, lack of refining capacity, uncertainty about where product flows and oil flows were going to go. So I think those were things that were fairly predictable to an extent, but made for favorable conditions in terms of trading. It was volatility, but what we call good volatility. 2025 has been quite different in that respect. I think we've seen sanctions come in almost overnight in places, which have caused challenges on vessels being trapped with oil on them, oil in chains. Obviously, the tariffs and Liberation Day created a lot of volatility as well. For the most part, those tariffs have not impacted energy flows too much, except for certain exceptions like LPG going into China. I think most people see raw commodities and energy as a vital industry and don't want to jeopardize it. And certainly things like gasoline flows into the US are seen as political as well. So we haven't seen too much influence on the tariff side, and to an extent that is more predictable. But I would say, you know, the way that Vitol looks at it, we've been much more on the defensive so far this year, trying to understand where the rules are going to change, what new sanctions are going to come in. You know, we've certainly increased our compliance functions. We've spent more time trying to talk to governmental organizations to understand where regulation is heading. But even then, the outcomes can be quite binary. I mean, we take, for example, now the next EU sanctions package and how they might treat products derived from Russian crude oil. If they adopt one mechanism of mass balancing, it has very little impact on the market. If they adopt one which isn't mass balancing, it has a huge impact on the market, and we don't know which way they're going to go. So that kind of uncertainty is pretty hard to trade, and so we have to be a little bit more defensive. Yes, there are opportunities within that as well, and I think all of those strategies on the board apply, flexibility and agility in particular. But you know, certainly it's a combination of both defensive and waiting to see where the opportunities turn up.
Dave, as the curator of some of the world's most important oil price benchmarks, are we seeing this sort of breakdown in trading rules? As one of the answers in the previous survey questions was distorting energy markets. How do you see this interfacing with the efficiency of the energy markets delivering an efficient price format?
Thanks, Sean. I think that the effectiveness of an international environment like the WTO framework here has always been overestimated. When it comes to trading, when it comes to you know, how molecules move around the world. And I think that the question here suggests there's a world where it won't be functioning, and I think on the flip side, when things start to break down, that's always overestimated as well. So I don't see that the WTO had a spectacularly important impact on norms of trade when it was at its height, and I don't think that its sort of erosion, if you will, necessarily changes trading norms too much either. And what I mean by that is trading norms are very, very important. And so, I mean, all five of these proposed... And
a trading norm, just by some casual definition?
I'll come to what I mean by that, Sean. Thank you. All five of these seem like good tactics. I'm not a trader, so it'll be for you two to decide which of these is most important for your businesses. But in the end, I would have picked either number 1 or number 5, because trading norms are, if there is an issue in the market with you and your counterpart, you find a way to resolve it in a way that reflects your relationship, your precedent in your relationship, your expectations in your relationship. I mean, ultimately, whether it's been COVID times, post-COVID, supply chain disruption times, you know, any time over the last 30 years, the relationships between two counterparts have always been most sacrosanct, I would say. And so it's ultimately having stronger bilateral agreements and having a more diversified set of relationships that you believe in that I think will take traders through this time. Not just traders, but every company in the supply chain. And that's why I say WTO is always overdone anyways, because if your relationship breaks down with a counterpart, you're going to see each other in court and not so much WTO to save you there.
Let's go to the next survey question and just give the next survey question on have we got a question 3? Is there anybody in the booth over there? I can't see. Yes. How will escalating tariffs and sanctions reshape global oil and LNG trade flows the most in 26, next year? Tariffs and sanctions will divert flows eastward towards Asia. 2, arbitrage opportunities will grow as trade routes fragment, or Western demand may rely on clean barrels while deepening east-west divergence. How will escalating tariffs and sanctions reshape global oil and LNG trade flows? If we can vote 10 seconds on that. Captain, or Sheikh, I wanted to get your thoughts on the idea that the normal flows and the bilateral relationships Dave referenced there, but ultimately this creates nearly a dual playing field. That we've talked before about the dark fleet. There's a universe over here, and then there's a universe of whatever clean the opposite of dark is, and that this dual system creates a challenge. Your thoughts on that becoming baked into the market?
Okay, well, I'll comment on this one.
Yes.
First of all, there is an energy mix which the whole world need. And I'm going to talk about the oil in the beginning. So let's assume there is 100 million barrel needed
every
globally.
day.
Well, this 100 million has to come from supplier and come to a consumer. The geopolitical situation sometimes lead this one, so it's going to change the route of this oil. But by the end of every day, those barrels have to find a home. So the sanctions and let's say the tariffs, let's say, all what they do is that they divert the route of the oil and the gas from destination to another. But by the end of the day, it's a whole cycle which has to meet everywhere. Coming back to your question about the dark fleet.
And a dual system.
And dual system. The dark fleet was created by the sanctions because there is what created the dark fleet now if we talk globally. Dark fleet is a resultant of, let's say, a demand that cannot meet by, let's say, the law or the international law. So there is two ways. People want to make economics. They have to supply some countries. They cannot supply them with the regular fleet, yet the dark fleet will service this one, the gray fleet will service this one with different economics. You know, the risk and exposure about dark and gray fleet, it's been growing so much lately. And it seems that I would say the market gave a space for those fleets to grow. There is a substance. The market gave the dark and the shadow fleet to grow because of the sanctions and the tariffs. People need oil. Those oil has to move. And if we mark it down, we can see it. All what it's doing, it's going to a different direction.
And is that a problem? Is that a problem? I mean, if the market's working...
in my opinion, it's been growing and it's going to create a lot of problem in the future. Now, it's a substance, it's a market that we cannot ignore. We cannot say that they don't exist. They're not shells. They are more or less now quite substantial, even determining the destination of a lot of crude and product. So if those is not regulated by any international, let's say, umbrella, this can cause a huge problem. I mean, now all what we see probably is a couple of collisions or small accidents here and there. But those uninsured, unflagged, moving from A to B, and those, in my opinion, those are moving bombs if they keep growing and nobody is leashing them. So yes, I think there has to be a way to put governance for those, at least, so we know where they're going and we know how to solve any problem if it occurs. And now I think, as we see, that this fleet is growing a lot, and it's taking market share. Started with let's say crude, now crude and product. I think it's going to go to gas very soon. It has to be governed by entity that really limit any exposure might happen in the future for those.
Tom, your thoughts on the survey question and the results, again, 39, it's pretty evenly spread across the three. Escalating tariffs reshape global oil and trade flows the most in 26. How you voted, what are your thoughts on this?
I voted for one. I mean,
which is ultimately a continuation.
Yes, exactly. I think that's the most obvious result of what's going to continue with escalations. It doesn't look like there's any wind down coming on any of the sanctions front at the moment. And the natural home, India, China, obviously some has been going west into areas like Brazil or into Africa, but I think that will continue the way things are heading, and obviously the 19th sanction package and what's been debated at the moment is likely to push that forward. Number two was less obvious for me, only from the point of view that the markets are getting very efficient at repricing almost instantly. You know, when a new sanctions comes out or a new energy flow is established, then the market realizes that very quickly. They adjust their balances, paper curves change, freight changes, and normally those arbitrage opportunities are shut down fairly quickly. They do create second-order effects, of course. So the fact that Europe is having to pull distillate from a long distance can create supply gaps, can create volatility in the front end of distillate in Europe, for example, which we've seen so far this year, which has been quite spiky. So there are second-order opportunities, whether it's a direct arbitrage opportunity or not. I think that's open for debate. And then the Western demand on clean barrels, yes, I would tend to agree. That certainly seems to be the direction of travel at the moment. And again, I completely agree with Sheikh Khaled's comments that you are creating a two-tier, maybe even a three-tier market where you have clean barrels, you have dirty barrels, and then there's a gray area in between as well, where some countries...
Turn your transponder off, turn it on. I mean,
I think that's probably out of the gray area, but into the dark area. But I think the gray area would be where certain counterparties are happy to handle it, certain countries, it's in a borderline, and how those flows travel will be quite defining in terms of price. I mean, so far this year, if you look at something like naphtha, naphtha discounts last year were on Russian barrels were very tight to normal barrels because there was plenty of demand for the Russian. And then the Koreans changed their minds, and that was slightly a self-sanctioning process. And suddenly the price dropped $30 or $40 a ton for Russian-related naphtha, even though sanctions didn't apply to those barrels. So, and then the market reprices and comes back again. So those gray barrels can move around, and maybe there's opportunities. But I think most of these sanctions provide arbitrage opportunities for companies maybe other than ourselves.
And do you see I mean, number one or number three, that that this is a now permanent reality, that we talk of these things as like, you know, a lot of the discussion this year was at the moments in which there seemed to be a push by the Trump administration to resolve the war in Ukraine, that things would go back to quote unquote normal. As a house rule, does Vitol see this as temporary still, or is this now permanent, or does it matter how you perceive it? It's just every day.
It matters how we perceive it, and every day we're putting on risks, whether it would be paper-related or physical-related, depending on how we see both tariffs and sanctions playing out. I like to think it would not be a permanent state. Certainly, as you say, halfway through this year, it looked like Russia-Ukraine was moving in the right direction. Iran was even moving in the right direction. We've seen sanctions being removed from Syria. And then suddenly there are turning points, negotiations break down, and you're moving in a different direction. I think we're all watching Social Truth. You know, we're trying to understand which way the next set of sanctions in the EU are going to go. What are the drones going to do? Now, obviously, right now the direction of travel looks quite negative, but I certainly don't think we're in a permanent state. I just think we're in a very volatile state in terms of trying to find the right balance.
Dave, your thoughts on that? Ultimately, the pricing system, the benchmarks, they're all built for whatever the normal world was prior to all of this recent turbulence. Are they still fit for purpose? Is every day a new day? You have to reassess? Or how do you see this era and its temporary or permanent and its impact on the pricing structures that we all rely on every day?
Yeah, thanks, Sean. So I think that the challenges for benchmarks that were generated by the contortions of the market over the last 4 years have shown that they're not only fit for purpose, but they're evolving with the industry. And I mean, I don't have the time, and maybe the audience hasn't got the interest to go into the really detailed stuff about whether certain kinds of oil can be reflected in certain kinds of oil benchmarks. But we've been through that with the entire industry.
Well, I suppose on that point, in the sense that in all the noise, one wants to keep a focus on what is part of a changing global flow, like WTI into Asia was happening anyway and continues to. It's not a relation to disruption.
Yeah, I mean, some changes in the global market are evolutionary in nature and take place over time, like WTI Midland flowing into Europe, flowing into Asia. is a decade-long story which markets needed to evolve towards as the markets themselves gradually changed. And then some are shocks, right? Some changes in market dynamics are actual shocks. So whether you can or cannot handle a barrel of Russian oil was a shock for the market, right? But I think, yeah, benchmarks are absolutely fit for purpose. They will always need to change, and they always do. And I think that they're going to have to evolve with these market conditions just like everything else.
On that, in terms of the fit for purpose, ultimately the resilience of the market, despite all of this turbulence, indicates quite a robust pricing structure.
Yeah, I would say so. I mean, benchmarks have a role to play in helping reflect the value of a fungible commodity. What is the most tradable, most active, most representative part of the market? And insofar as benchmarks are able to do that, they help people manage risk, they help people manage arbitrage. I actually voted for arbitrage on this one because, which makes me worried that Tom voted the other way here since he's a Vitol. But I think, you know, as you know, benchmarks play a role here. As some ARBs close instantly and others open instantly, benchmarks will help you to make that determination and manage the risk and manage the flow and everything else. So, but I think that we can be very sure that in this environment, ARBs are going to be changing on a moment-to-moment basis.
I just want to put out there, if anybody would like to ask a question from the floor, if one of the floor assistants takes the microphone, if you put your hands up and we can call you in to ask a question. If we bring up our next survey question, please. If you just put up your hand if you'd like to ask any of our three panelists a question. Can bilateral and regional trade agreements replace multilateral governance for energy markets? Yes, no, only partially. 10 seconds on that from a point of view of voting. Can bilateral, we're seeing a lot of bilateral emerge in the world today, driven by the sort of Trump negotiations with every country individually suppressing the WTO architecture, which is obviously quite critical for smaller countries in particular. Only partially can bilateral and regional trade agreements replace multilateral governance for energy markets. Sheikh Khaled, as you proceed to set up your KPC trading structure, and obviously it's an evolution from the system you already have in long-standing in KPC marketing, does this breakdown of multilateral versus bilateral, how do you see it? Is it relevant to the decisions you're having to make now as you put money at risk like Vitol have been doing for so many years?
Well, as you know, KBC, when they started the trading company, they started after doing the marketing. So we've been in the marketing for quite some time.
Yep.
And all what we are doing now is, let's say, trying to capture the last cents and pence, let's say, in those one.
The last cents as in not in your brain, but cents as in money.
Exactly.
Or maybe it's both the same thing.
Well, okay, so we are converting our marketing strategy into a trading. Yet, you know, I don't want to go into our strategy, but we've been establishing a market share in many areas, which we want to keep those markets. But now we found out.
For example?
Okay, we have a good market share in Asia, Africa, and I can say most of our naphtha, if not all of it, goes to the Far East, and it's either to end users or, let's say, traders that will take it to end user, and that's when we are talking about LPG and naphtha. Nowadays, after we started the Zoo refinery at 600,000, we have 1.4 of refining capacity in every day. There is a huge demand for fuel oil. We have around 35 million of middle distillates. And we found out that, you know, there is a good opportunity that we can capture better premium if we go into trading. So we're going to maintain the trading, or let's say maintain the market share that we always have, and we'll deal with the extra barrels on a trading basis. We still sell to the traders, yet establishing KBCT is a step, let's say, to go into the trading world. We've been among the first guys maybe in the area who wanted to start trading, Yet it took us some time to take this decision. Our neighbors, our friends in the area started, and we've seen quite a successful journey for them. We started in April. We are doing this one.
You're one of your colleagues sitting in the front row there, Abdullah Dosri, one of the founders of Aramco Trading.
Well, Abdullah is a quite well figure, and he's my cheat sheet, by the way, in the trading world. So honestly, they've been having a great experience. And we've seen that they've started with all their products. And eventually, I remember even the LPG and sulfur, they haven't started with it. Then they, took the whole product into trading. And I'll probably in our side talks, yes, they're making better premium than selling with the usual marketing style that they used to do or what we're doing now. Okay, every country, every company have strategy. Do you want to maintain your market share? Do you want to, let's say, diversify? There is some exposures sometimes when you have 1.4 refining capacity of
1.4 million barrels a day of refining capacity in Kuwait.
You want to make sure that you maintain and keep a good market share. You built a good relationship with customers. They don't want to disrupt it. We don't want to disrupt it. And by the end of the day, there is a way to communicate. Maybe in your first question was the relation between the customer and the supplier. Always, let's say, lead and come in the first, place. Coming to this one, it's I think everybody agreed partially because it's governed by let's say, financially. It's governed by how much bilateral, let's say, trade you can do. So it's limited. So it will not affect the trade or, let's say, replace the trade. There still be a buyer and seller, and bilateral probably can replace small segment of this one, but cannot replace it even with sanctions, with whatever.
Tom, I wanted to get your thoughts on that same thing. As we, the world's largest independent trading company and all of your peer group now, and Sheikh Khaled and the new peer group on the NOC side over the last decade, and with Aramco Trading at the forefront, and now the latest KPC Trading and Babco's Trading, that their emergence over this decade, but particularly at this time and with this idea, they, as government-owned entities, obviously they have advantages as owners of their crude, but also advantages at the ability of navigating this kind of turbulence as a bilateral ability of government to government. The independents don't have that. I'm wondering, is that an issue? Do you see, obviously, the emergence of this competing peer group, but also with, at this time, that added muscle that they would have over bilateral that you would not have, and then more reliance on multilateral? Just speak to that if you think what your thoughts on that is.
Yeah, we've seen the evolution over the last 10, 15, even 20 years of NOCs coming in and taking a bit more control of their barrels. KPCT is definitely not the first, as we mentioned, Aramco Trading, NOC Trading. It's a natural evolution.
And you guys obviously were involved in incubating OQ Trading.
Absolutely, yes. It's a natural evolution that markets trend towards more efficiency, greater level of sophistication, and we want to be a part of that process and work with these companies as our partners. So, Vitol is migrating a little bit away from being a pure trader into owning assets and downstream. We have multi-year relationships with various countries, and we can see an important role for these companies. Rather than us buying from them FOB, they can deliver to our customers. And we welcome that participation in the market. But
so in a way, you become a kind of a greater mirror. You've got the trading part; they're building it, but you don't have the asset parts that they have. So it's in a way.
I think it becomes a balance ultimately. We've seen some companies overreach and think that there's value somewhere, and then they realize it's a bit trickier, whether it's financing or logistics, and then they back off. And everyone needs to find the right balance, as Sheikh Khaled said, to find those last cents and make sure they're monetizing their barrel efficiently. and pulling it back into their own loop. And that's a journey for most. Markets change all the time, which is why the question about bilateral versus multilateral, I don't think anywhere in the history of the world having a one-on-one trade relationship has sort of been productive for having competitive, efficient markets. So I think it's important, while government to government creates some stability in places, and some people would like to have that sense, really energy is a physical molecule that needs to come from multiple locations, and multilateral, whether it be between counterparties or across different regions of molecules moving in, is vital to create competition, transparency, and the most efficient price at the end of the day.
Dave, your thoughts on that, and please, Khaled.
Yeah. Well, one thing which I want to mention, all the trading houses, I think they are supporting, let's say, the national trading houses. And the reason why is that, I can tell you, let's say, sometimes I would sell the trader a cargo and might buy it from him again in a different location when the economics make. So when the national oil company is going into trading, I don't think they are replacing or, let's say, taking a space from the traders. All what they're doing, they are cooperating with them to make an extra, let's say, premium. At the same time, we can leverage on this relationship. There is sometimes a lot of talks that, national oil companies coming into trading that will diminish or let's say, downsize the other. I see it the other way. I think now, with the cooperation, with the relationship, with the market, that we can either arbitrage or we can do a lot of trading with them, which makes a lot of benefits for both traders.
In a way, given that as you move into this sort of last dollar value, if you like, and it is also includes a much greater international engagement. You've got to go right across the world. You have your markets, as you said already, but as you go globally with the physical trading, you will need more partnership.
Indeed. Sometimes I wouldn't need to go and ship and take vessel and move my product to X while I can swap it with one of the traders. He's happy, I'm happy, and we save a lot of operation. And that will probably give more catalyst to the market, to the flow of trading. As I said in the beginning, there is, let's say, 100 million. It has to be moved somehow. And it's regardless coming from X to Y, those values has to move. So sometimes if Tom have a volume, I'll take it from him and give it elsewhere, and both of us happy,
Dave, your thoughts are just picking up on some of those themes as we see the national energy traders emerge in the world, obviously emerge in your window, in your pricing. How is all that playing out? What's just more customers, more business?
So I congratulate Sheikh Khaled and Tom on having a very thoughtful conversation up here today with the room, because around this topic.
Yeah.
Because it is fascinating, as I think you coined the phrase just now, the emergence of national trading houses, I think you called them, alongside the international trading house community. Fascinating how that both changes the dynamic of the global markets, and yes, participation in the Platts assessment processes, and that's one of many thousands of effects that dynamic has. But what's fascinating to me about it all, and we spend a lot of time with the NOCs and the IOCs and the traders and many others in the industry, is that I ask myself the question, how is it that traders are able to generate profit? And how is it that national oil companies are able to generate profit? And is that easy to do, right? Because as national oil companies move into trading, they're going to have to figure the answer to that question out. And as traders move into operating assets, they have to figure out the answer to the other question, which is how to make a margin off a Mars bar from running a refinery
Yeah.
or infrastructure, right? Neither of those things are easy to do. And part of the answer is that a lot of companies don't make money out of doing either of those things.
Well, we saw IOC struggle with becoming utilities.
Correct. So I am sure that everybody here is going to be wonderfully successful, but it isn't going to be easy for everyone. And there are going to be a lot of tough lessons to learn along the way. So, you know, if we provide a service and all of that, it's by being, you know, an intermediary. We spend time talking about how these markets work with really anybody who's interested. I was talking about trading norms earlier and how trading norms are kind of, in my mind, more important. Trading norms and bilateral relationships are actually more important than multilateral governance, in my opinion, because ultimately these markets depend upon strong bilateral connectedness and adherence to norms, actually, right? It's not going to be easy for anybody, is what I'm trying to say.
Yes. Let's skip the next question, because the last question is right on this topic that we sort of leapfrogged into as our final topic. And I'd just like to get the room's view on some of this. How will the Middle East national oil company trading firms adapt global expansion plans in a world of shifting rules and alliances? A lot of global expansion plans have been on the cards for a while. I mean, as mentioned, KPC now 1.4 million barrels of refining. That's planned a long time ago and coming to market at a time when the shifting rules and alliances are active and real. And so how will Middle East NOC trading firms adapt global expansion plans? Some have a big commitment to integrated downstream refineries and petrochemical plants all across the world, particularly across Asia, with multiple billions of dollars. So one, NOCs to accelerate emergence as global traders, taking on more risk, acquire assets. We've mentioned in our conversation here, Abdullah and Aramco Trading taking 10 years or more to progressively move through the risk awareness and appetite. Will this new era force KPC trading to have to move a lot quicker to accelerate its emergence and not have the long time that Aramco Trading had? To accelerate their integration of strategies upstream, midstream, downstream, which we've seen a lot of talk about that integration across. We even had talk not so long ago, 2-3 years ago, of Aramco and ADNOC doing an integrated joint venture downstream in India. That never happened. Will it accelerate now? 3, prioritize geopolitical partnerships, especially in Asia, which I talked a little bit about there. The NOCs are more in a better position to have geopolitical bilateral relationships. So a lot to think about in that question, but ultimately I think it's an important one. And hence why I'm delaying saying 10 seconds so people have a bit of a moment to think of it. But 10 seconds, how will Middle East NOC trading firms adapt global expansion plans in a world of shifting rules and alliances? And if we get closing final comments from our panelists on that. So Sheikh Khaled, your closing thoughts on that question, but on all of the themes we've discussed today, and particularly from the prism of you now shepherding a new trading company into existence.
Okay, well, Sean, it's very good way to limit only to 3 answers. Yet
yes,
I think
know.
It's much more than that.
I know.
Okay. Now, when we talk about trading, the definition, what is the definition of trading? There is marketing and there is trading. And there is a very thin line between both. Okay? Trading is making the more flexibility of making the more premium and using the paper market risk management tools to, let's say, cover the position that you take. Now I see, let's say, when we talk about NOCs, most of the NOCs now, they went in a partnership in many refineries outside. So now they want to secure their outlet. Let's say for KBC now, we went in China, we have a JV with a giant petrochemical company, Wanhua there. that will secure, if we take it another way, will secure a good outlet for us, LPG and naphtha. So what I'm trying to say in here is that the trading is enhancing the marketing element in another way of and shape of form, and making, let's say, the premium that everybody wants. This, you know, in another world, what you need is an outlet. Some would cover it with the paper market, some would cover it to the end users. Yet, I think it needs a long journey, but I think most of the NOCs have been in that journey through marketing. So now all what they're doing, they are enhancing, they're going for the premium that they can catch, which they think they lost along those years by trading. And I think with alliances, as I said, partnership, not necessarily on paper, but when I say partnership, a deal is a partnership. So this is the way that most of NOCs are doing. You know, we have refineries outside, we have a lot of outlets, even with traders. So that would let's say, convert the NOC marketing into a trading in very smooth way. Yes, challenges will be always there, but sometimes, you know, what it makes it easier, you know, cooperating with, let's say, the industry. So there is places, I don't want to go there is risk. Others are willing to take it. Producers, I care about, let's say, big cargoes. Others, they are interested maybe in less than 1 KT. I'm not saying we're not going to go into that stage. We will go into that stage. Yet for the time being, I think there is a room for everyone as long as we cooperate in the trading pattern that imposed by the market.
Tom, your closing comments, and just picking up on some of the questions, some of the comments by Sheikh Khaled there about, you know, we talked earlier that as a trading house, you have to think, we were talking about Russia and Ukraine and whether the war would end or not end and sanctions would be removed and so forth. But you also have to consider how will NOCs keep evolving in this world? Could they accelerate? Could they buy more assets? Could they, and does that figure in your thinking? Obviously, you're going into more assets now because of this change already, but how does the evolution of NOCs trading houses make you think about the things that you don't know they're going to do, but you'll have to start thinking that they could come into other areas of your business? You're going into assets, they could come into, I mean, is that something that figures for you? Your thoughts on that?
Yeah, there's obviously areas of cooperation and there's areas of competition between the NOC trading houses and ourselves. And as they get more sophisticated, some have more expansionist approaches and some are more content at the moment to just extract the best value from their barrel. You know, where we overlap, we can also collaborate as well. I mean, looking at these questions, I would say to trading firms 1 and 3 is more relevant. For number 2, you know, whether you go upstream, midstream, downstream, the world's 5 years ago was thinking that a lot of assets like refining and downstream retail petrol stations weren't really the space to invest in because of transition and as we've seen in Europe, some competition and tough environmental or regulatory environments means there's been quite a lot of shutdowns. So now you're going into quite a bullish midstream market, and the downstream is being more heavily competed as people are flipping those strategies. I mean, we've taken a strategy of we don't have much on the upstream, and we have little bits in West Africa and in the US, but it's independent stuff that is not competed by the NOCs. On the midstream, you know, we've been opportunistic about refining capacity. We're up to 850,000 barrels a day now, which is not insignificant. But again, we don't see that as being competitive. We do look at the landscape in terms of what expansions are coming on, what are the NOCs going to do, how do they place their barrels. I guess on the downstream side, there's 2 areas there. There's the retail side of it, where we've expanded and we do see more competition coming in. But there's also the petrochemical side, because everyone's anticipating by 2050 that half the barrel is going to be petrochemical and transportation fuels are going to decline. So we're seeing a huge build out on the petchem side to create downstream demand for the barrels, and that's sort of led to a bit of an oversupply at the moment. So we factor it into our thinking a lot. We try to anticipate. We try to participate in the areas that we feel we've got expertise. The NOCs have naturally got a big advantage in terms of they're trying to upgrade their barrel the whole time. As government organizations, they can have government-to-government type conversations that we can't necessarily have, but we can participate alongside them. So I think, to answer your question very ramblingly, but you know, where we see the NOCs coming in is a natural evolution for us, and hence why we've kind of worked to make a more secure base, to have our own outlets, to have our own infrastructure that we can trade around, and then we can work with the NOCs around that in terms of sharing flows and swapping flows and having a more value-add piece in the supply chain.
David, last word to you on the question, but also just speaking to the idea of, we've been talking for 40 minutes now, and we haven't mentioned the word AI, that the KPC trading and the NOC trading, the luxury that early movers, OQ trading, Aramco had, maybe not afforded to KPC and Bapco, in the sense that they'll have to move a lot quicker. They're dealing with much bigger, the digital challenge of AI and other such things. Just speak to the question and also to that idea.
Absolutely. So I'll try and do both those things real fast. So for me, the answer to this question is hands down, very clearly, number one. If you look at entering the market from a national oil company's perspective, they will have to,
Just
they'll have to, by definition, take on more risk. I mean, by definition, they'll have to take on more risk. It's a given to me. The other two, yes, of course, but take on more risk, because you have to. If you're in a market, if you join a market and you weren't in a market, by definition, you're going to take on more risk. Now,
yes.
So it's easily, for me, number one, and I appreciate why people voted 2 and 3. I don't understand why so many people voted for number 2. You need to think again, at least if you're a national oil company.
Go back to school.
Yeah, well, just think again. Put yourself in the shoes of a national oil company is what I'm trying to say, right? Think about it from their perspective. This premium that the national oil companies are chasing in the market, why is it there? Like, the premium is a reward for taking on risk, actually. What is the best trade in the market, or what was the best trade in the market from my perspective, at least as an observer, in the last 3 years? It was buying Russian oil FOB Primorsk, delivering it to West Coast India, and taking $18 for the trade, right? Why is that premium there? It's the riskiest thing in the world you could possibly do, right? I don't know, don't want to look at you guys when I say that, right? But the premiums represent the risk. So, to your point about AI, I think that national oil companies will have to get on the AI bus yesterday, because the trading companies already did it. I'm not going to say what Tom and I were doing yesterday during some of the sessions. We were asking, well, I will say, actually, we were asking we have our own chat AI functions. We built one at Platts, one at Vitol. I'm sure everybody else has. Sorry, Tom, if I'm revealing any secrets there. But, we are already using this stuff. So if national oil companies, or indeed anybody else, is not using AI to try and figure out where the alpha is and where the risk is, and therefore where the premiums are, there's absolutely no chance.
Well, there's a way to finish. Thank you, Tom Baker, Vitol Bahrain, Sheikh Khaled, Al-Sabah, Managing Director at KPC, and Dave Ernsberger, Co-President of Platts. Shukran, thank you very much.